What if I told you that keeping too much money in the bank is one of the most dangerous mistakes you can make with your finances? I've worked in finance for 15 years and I've seen this mistake cost people their financial future. Right now, £526 billion is sitting in low-interest accounts in the UK, and all of it is losing value every single year. So in this video, I'll show you why keeping too much money in your bank account can be a terrible mistake, but most importantly, what you should be doing with that money instead. Inflation. So firstly, if you have money sitting in a bank account, no matter how much it is, then every year that money is having its value eroded, day by day by day, by inflation. Because here's the thing, if you had £10,000 sitting in an account, then that £10,000 doesn't stay worth £10,000. Its spending power, and therefore your spending power, reduces over time. Here's what I mean. When I was a kid, you could get 100,000 Freddos for our imaginary £10,000. But now that same £10,000 will only get you 43,000 Freddos. That is inflation in a nutshell. And while we're clearly using this as a jovial example, and I do run the risk of potentially having a fatal overdose of nostalgia, when you zoom out and look at the cost of just about everything, it's the same story. People think that because the literal amount that they see on their bank statement every month, because that isn't going down, then inflation must not be affecting them. But that totally misses the point. That's just totally wrong. The reality is, if we take our £10,000, in 10 years, assuming a 2% average inflation rate, that money will actually be worth £8,200 in real terms, meaning after we account for inflation. So it's actually worse than people think. It's not that your money isn't growing, it's that your money actually buys you less than it used to, investing. So what do you do about this? Well, by having excess money in your bank account, you're missing out on the opportunity to put that money to work, to go out and have that money make more money for you. We call this opportunity cost. That is everything you forego when you make a decision with your money. But here's the thing. When you put your cash to work, it's the best kind of worker. It works 24/7 and on average will always give you a return over a long enough time horizon. And the longer you leave it to work, the more money it will make for you. Let me explain. Let's say we take our imaginary £10,000 and invest it. You get an average annual return of, say, 8% a year, which historically speaking is the average rate of return of the market over time. And in 10 years, your £10,000 is worth £21,000. Now, I see comments under every single video where people say the same exact thing, that an 8% return isn't realistic, that you need to be doing something illegal or investing in all the wrong sorts of things to get that kind of return. Now, I want to get into more details in the numbers later on in the video, where we'll be going through what you should be doing with your money instead. I want to fully explain these numbers, not speculation looking at cold hard facts. So not investing can actually pose a bigger risk to your financial future than the market volatility that people are worried about. You're trading the possibility of losing some of the money that you invested over the absolute guarantee that your money will lose value by inflation, which we mentioned at the start of the video. Right, on to our third point, the hidden tax trap. In the UK, you have to pay tax on the interest that you make from savings and current accounts. And, because these things are never easy, the allowance that you get, known as your personal savings allowance, depends on which marginal income tax bracket you fall into. A basic rate taxpayer will get £1,000, a high rate taxpayer gets £500, and an additional rate taxpayer gets no personal savings allowance at all. Now, just to illustrate just how mad it was back in the day, if you got 0.1% in a savings account, which, wasn't unheard of back then, and you were a basic rate taxpayer, you needed £1 million to hit that £1,000 personal savings allowance limit. But as interest rates have gone up in order to try and quell inflation globally, this has meant that more and more people are hitting their personal savings allowance limits. And just to give you an idea about how much this has changed, if you put money into a bank account and you got, say, 5%, this means if you're a basic rate taxpayer, then you need to have £20,000 in a savings account to hit your £1,000 limit. Far a cry from the £1 million you needed before. Next up, a false sense of security. Now listen, it's not lost on me. I do get it. Seeing a big number on your bank statement every single year must feel all safe, give you a real sense of security that you can take on the world and do absolutely anything. But here's the problem. That safety often guarantees long-term loss. Now, it's a weird concept, I know, but let me explain. Because the value of your money is decreasing over time, as we've mentioned, the bigger risk might be that actually people confuse safety with inactivity. They look at what they have, which is the money sitting in their bank account, without realizing it could be working harder for them than it is now. But the problem is, This is all your eggs in one basket kind of situation. You are banking on this money and only this money to secure your financial future. And the truth is that real financial security comes from diversification of income and assets, not hoarding your cash somewhere where it isn't earning you any income and is all in one place. The comfort of a cash pile or massive nest egg will blind people to bigger opportunities. It might feel nice and safe, but it's just completely blinding you from making better money decisions. Next up, your money gets trapped. So there are limits to what you can do with your money in a bank account, which we've kind of discussed to death already. But worryingly, there are limits to what you can do with your money when you want to try and get it out. Let me explain. In the UK, you've got a £20,000 annual ISA allowance and a pension contribution allowance of up to £60,000 a year. But these limits are very much use it or lose it limits. So the issue here is that if you let your cash pile up in your bank account, then when you realise years later you actually want to invest it, you can't go back and retrospectively use your ISA or pension allowances that you've already missed out on. The money is now stuck outside of these tax-efficient wrappers and exposed to dividends tax, capital gains tax and income tax. So if you had, say, let's be super generous and say you had £100,000 in a bank account, a nice situation to be in, I know, but just work with me on this, it's just an example, then it's going to take you 5 years to get all the money in there. That's 5 years of potential gains you're missing out on, 5 years of compound interest you're missing out on, 5 years when you could be doing other things with that money that you're missing out on. Protection. So under UK law, you get protection in case of bank failures. This is called the FSCS protection, and that means the government will basically underwrite your losses of up to £85,000. And this is a point that most people get wrong. It's an £85,000 limit per person, per bank that it's protected in the UK. Clearly, this is a problem that most people will never have, but if you're saving for a house deposit or some other big expense, then it is something that's worth keeping in mind. Paying off debt. Listen, I know that this might sound like an obvious one, but if you have debt, but you also have money, excess money, sitting in a bank account, then that is accumulating interest that is not in your best interest. It's also not the best allocation of your capital. There are 4 key points on this one. Overpaying debt is a guaranteed return. If you're getting charged 7% on a loan, say, and you repay that loan or you make an overpayment, then that 7% is a guaranteed rate of return. Second, higher interest debt will grow faster than savings interest. For all the reasons we've explained, compound interest can work in your favour when it's making you a return on money that you've invested. But if it's interest on debt that you need to service, then that's a totally different story, and compounding will work against you. Third, clearing debt frees up future income for investing. Listen, if you have to make a credit card payment of £300 a month, then once that's taken care of, it's another £300 a month that you've freed up to do something more productive with. And fourth, psychologically, paying down debt reduces your stress. Studies show that having debt is more stressful for people than having smaller cash cushions. Now, don't forget, at the end of the video, we're going to be going through how much you need and what you should be doing with your money. But let's move on to the next point, which is lifestyle inflation. Now, I've got to be totally honest, this might say more about me than anything else, but find me a person in the world, and they clearly do exist, who has a large cash balance and isn't tempted to spend some of it. They see something that they want to buy, they look at their bank balance and they go, well, that wouldn't even hit the sides. I'm going to buy it. Or they think, it costs this, but I have this, so why can't I buy it? Some people misinterpret this as they'll go out and spend maybe not all of the money, but certainly some of the money, but that's not really the point. The question here should be focusing on if they didn't have that money sitting in a bank account doing absolutely nothing, would they spend that money anyway? Just because you have the money doesn't mean that you need to go out and spend it or that you should. Lifestyle creep is one of the biggest wealth killers out there, no doubt. One pot, too many uses. Now, we have for a long time on this channel, and I suspect for even longer, advocated for having separate savings pots with separate jobs. One of the biggest mistakes that people make with cash is piling it all into a single savings account and thinking that they're organised. But that pot often ends up doing too many jobs at once. It's where your emergency fund sits, it's where the holiday money gets stashed, it's the house deposit, it's maybe where they have a little pot for, I'll invest this one day. But this is a mistake. Now, don't misunderstand. You should still be saving for the things, making sure you have the money to buy them before you go out and buy them. But having separate pots for each of those big transactions is key, because the problem is, if you have it all in one place, it completely blurs your financial goals. You might think you're saving diligently, but in reality, you don't know what of this money is earmarked for what. And that lack of discipline and lack of transparency makes it really easy to dip into the wrong money at the wrong time. But the main reason is that it's completely impossible to determine how much of your money is going towards each goal and therefore how close you are to each savings goal when it's all meshed up and mashed up into a single bucket. The illusion of liquidity. Now, one of the things that I've noticed, and I will concede it's not as prevalent now as it used to be, but I still think it's something you should keep an eye on, is that in order to secure some of these very good interest rates, you would have to invariably lock up your money for an extended period of time in order to secure those rates. And in the worst cases, you had a penalty if you want to try and get that money out. Yes, for the most part, you can get access to your money with little to no fuss most of the time, but you should just check on the other things like daily withdrawal limits just to make sure that that meets your real needs. Real liquidity is being able to use your money when you need it. So we've discussed a whole lot in this video, but this gets to the most important part of the video. What should you be doing with your money? As we mentioned earlier in the video, this fear of risk could actually cost them more than the risk of investing would. Now, let me show you what I mean based on literal hardcore data, because right at the start of the video, we said we would cover this. So the first thing to look at is this. This shows the stock market returns, in this case, the S&P 500 or the 500 largest companies in the US. This is just an example, but the same principle applies. As you can see here, we have all sorts of global, economic and political and social events. You have Reagan meeting Gorbachev here, you have the fall of the Berlin Wall here, you've got Obama getting elected here, you've got Donald Trump getting elected here. But what do you notice? That through all these events, the market has, over the longer term, and that is the key part, has continued to go up and to the right over time. And what this data shows us is that £10,000 invested in 1970 would today be worth close to £2.2 million. Now, this means that the average, and again, average is the important word here, the average return of this index is 10.88% per year. Now, we should also point out that when you account for inflation, this number falls to between 7 and 8%. And given how much we've discussed inflation at the start of the video, I must confess it would be remiss of me not to mention it. Now let's get to the crux of this. People have an understandable fear of investing, but this fear is often based on short-term market headlines, the insane stuff that they see on the news, or a friend's horror story about a meme coin that they invested in and lost it all. But over decades, markets rise on average. But what do these two data points really tell us? That the longer the time period that you're investing in, the less likely it is that you'll lose money. Waiting for the perfect investment moment often leads to people sitting on cash indefinitely, thinking that they are traders, not investors. But the truth is, time in the market will beat timing the market. Let's just look at this analysis. $1,000 invested in the S&P 500 in 1970 will give a total return of $138,908. If you miss the best performing day, you're down at $124,000. The best 5 days and you're down at $90,000. The best 15 days and you're down at $52,000. And the best 25 days and you're down at $32,000. And this really exemplifies what we're talking about. Little and often invested into the market over a long enough time period can really dramatically reduce your risks. So how much money should you have in your bank account? Typical advice is to keep between 3 and 6 months of your expenses, based on your personal circumstances and appetite for risk. But that's the maximum amount you want to be keeping, 3 to 6 months of your living expenses. Then what you need to do is open up an ISA. This will let your money grow free from income, dividend and capital gains tax. You have a £20,000 per year limit, and it is a per year limit, not a total limit. So now you've got your ISA, what do you buy? The simplest thing to do is to buy a globally diversified index fund. You're diversifying your risk both geographically and across all the companies that sit within that index. And this is an investing strategy advocated by Warren Buffett, potentially the greatest investor in history. Secondly, you'll also benefit from very, very, very low fees when compared to actively managed funds. And as always, we should point out that time and time again, passive funds like index funds have been proven to beat actively managed funds. This means that you're getting better returns and you're being charged lower fees for those returns. So it can be as simple as that. Opening a stocks and shares ISA, putting your excess money in there, a globally diversified index fund, and just set it and forget it. And then start topping it up with those contributions every single month. And this can be one of the best ways to build long-term wealth. The earlier you start, the longer you give compound interest to do the heavy lifting for you. Now, we've discussed an awful lot in this video, but all of this is worth absolutely nothing unless you watch this video here. This is the optimal order to invest your money and will give you a really detailed step-by-step guide to how to invest your money. We also have this video here, which is Secrets for ISA Millionaires, the 10 signs you could retire earlier than you think. If you've liked this video, please like and subscribe. It really helps the channel. Thanks very much for watching.